was what was totally absurd and original about that moment?
The biggest surprise for me is that we heard all these people saying the world was going to fall when you didn't have zero rates. And the fact that it hasn't continues to be one of the biggest surprises that we haven't seen, the complete demolition of balance sheets that were really grown up, that were really raised in zero rate policies.
How many people came on this show and said the long and variable lags would be 30 years long? Hardly anyone did. No one did.
No one did.
And now it's like, yeah, they're longer, much longer. Kelsey, good to see you. Kelsey Berrow of JP Morgan Asset Management. If you are just joining us, welcome to the programme. The scores look like this on the S&P. We are positive by 0.3%. Yields are a little bit higher by 4 basis points, 4.2916 on a 10-year, which is quite a turnaround, Lisa, from the start of the month.
And it really raises this question to Kelsey's good point, which is how much is the trading moving so much faster than anything fundamental? The narrative is shifting so quickly and people are getting on board. Again, the technicals underpinning this. It raises this question, especially if you've got the likes of Bill Ackman coming out and making these bold rate calls. I mean, what is the hedge fund activity or the levered bets that are behind some of these moves?
It's the psychology of investing. It's always the same. It never changes. You get to 5% and people are like, sell, sell. You go back to 4.30 and they're like, oh, quickly, buy, buy. Yeah. It's the same in the equity market.
Yeah, although you do wonder if things are moving faster than they have before, just in terms of the narrative shifts. What is the saying or something that the markets are the only place where you buy something when it's full price and you sell it when it's on sale?
Oh, yeah, totally. Totally. I totally agree with that statement.
That's where we're at
like anything else, right? It's like the sales are on, let's go.
Yeah.
And now in markets, it's like, no.
What do they know?
Oh, my, no. Coming up next hour, Neil Dutt of Renaissance Macro, why he thinks it's soft landing nirvana for this.
The quickest way from a billion points of data to a point of view. SAS Viya.
So let's go inside the boardroom. Let's suppose you win a proxy fight and or you just get invited onto the board. You go to your first board meeting and you're the person who's saying you can fix this company, and all of the others on the board of directors are saying, well, we're doing pretty well. How do you get received when you start saying, here's what I wanted you to do?
Well, first of all, we don't bring that to the boardroom. Our time is spent with the CEO, the chairman, the CFO, and share our plans with them outside the boardroom. We try never to solve an issue in a boardroom. Okay, it's always best done the day before, the week before, outside that room. We wouldn't be there if they really were doing well. So it's really hard for them to straight face and tell us we're doing well. And we present them with a plan.
Lots happening on Wall Street.
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From businesses most influential and instrumental.
America's economy needs a diversity of institutions.
That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
From New York City.
From London, in Sydney.
From Washington.
In Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
How to strike that balance between ultimate values and what reality imposes on you. And reality is never quite adequate, but ultimate values are too absolute because they demand a degree of imposition on others. How to strike that balance is maybe given to us as our insoluble problem.
That was former Secretary Henry Kissinger speaking to Bloomberg editor-in-chief John Micklethwait earlier this year. Kissinger, the former U.S. Secretary of State who defined American policy in the 1970s, has died aged 100. I'm pleased to say that joining us now is John Micklethwait, the Bloomberg editor-in-chief, joining us from London. John, good morning to you, sir, and great to catch up as always. Let's talk about the legacy of a polarizing figure, a man who you knew for the best part of 3-4 decades. What is your takeaway on that?
I think he was a giant. I mean, obviously not a giant physically. He was quite a small man, but he was a giant in the sense that it's very difficult to think of anybody else. I was just thinking as I walked through the streets of London this morning, the possible exception of the Queen. I don't think there's anyone who had been part of public life for as long as Henry Kissinger, had met as many people, and had, in his case, obviously more controversially the Queen, but had such a dramatic effect on it. I think he was someone very obviously in terms of legacy who changed the world through the bringing China back into some kind of unity with the West and bringing China in from the cold. I think that was a huge deal. You look at détente, all the different things like that. And yes, there were very public and very obvious costs to that. But he was a man of many, many parts. And I think it wasn't just the things he did, it was the breadth of his interest. At the end, he was consumed by AI. But this was a man who was quite a formidable student of history, and that's how he first emerged. And he had a personal life story which I think kind of captured the century, beginning as someone persecuted, driven out of Germany, arriving in America, coming to serve in the Battle of the Bulge as a still incredibly young man. He saw things by the age of 24, 25 that very few people have seen who are currently leaders of the world.
John, in the 4 decades that you knew him, how did his worldview evolve, especially with some of the shifts that were going on globally?
I think he did change his views, but his basic attitude, and that somewhat convoluted quote that you began with, I think is very true of the way that he saw the world, that there were a set of values, but then there was also reality, and the two conflicted continually. And so I think particularly when he was in office, there was a lot of trying to compromise in terms of what he was trying to achieve with the realities there, and sometimes those were spectacularly bloody. That's why people will bring up things like Chile and Cambodia and places like that. But his underlying sense about the direction in which he wanted to go, I think, never really changed. And he continually also, I mean, in some ways, it's psychologically interesting, his desire to be relevant, his desire to still be part of the debate. A man who's age 90-something discovers AI, but thinks that that is something you should look at through the lens of Metternich, through the lens of balance of power, and what that can do to the human condition, and what that could do in terms of war. Most obviously, the idea of computers fighting each other terrified him. But also that basic idea about what it meant to be human if you had machines that began to think of human, that went right the way back to the political philosophy that initially grabbed him. So yes, I think the reason why he's interesting is partly the life story, both in the sense of a child whose odds of survival were extremely small, ending up as one of the most powerful people in the world, and that desperate and rather ingenious ability to stay relevant long after he stopped being Secretary of State, long after he stopped being National Security Advisor. But also this sense of having something sort of bigger about the world. Kissinger was never someone who ran away from large issues to do with philosophy, large issues to do with science. Any of those things he sort of sucked in. So he was a complex, sometimes a very intriguing man. But he was, to that extent, I think he was one of the most influential people of the time I've been a journalist.
We've mentioned how polarizing he was in several occasions, and you talk about how he was guided by right and wrong and less concerned with the method of getting there. Come under a lot of criticism from the bombing campaigns, as you mentioned, in Vietnam, in Cambodia, with Pinochet in Chile, also with respect to how he really directed policy toward Russia. How much of his philosophy is consistent and strange today of U.S. foreign policy?
I think that an interesting question is that if you look at American foreign policy over the past 30, 40 years, and different times it was run by people who were extreme critics of Kissinger. The neoconservatives hated the idea of realpolitik. Bill Clinton liked the idea of a more kind of worthy foreign policy, so did Barack Obama. You have to ask yourself the question, would America be stronger if Kissinger had run it? I suspect It might have been. Would the world be more peaceful? I think possibly it might have been as well. I think he always took the long view. And you look at the issue of America and China, the one which sort of dominated a lot of the questions of the past 10 years. What Kissinger repeatedly did was he went back to the issue about great nations have kind of interests, and you have to find ways to accommodate that. So yes, by all means, bring up the issues that divide you, but then try and work out what is possible within the parameters of the interests of those nations. And the reason why he had that, I think, was partly to do with history, the people he studied, people like Metternich, Talleyrand, those were his heroes. They dealt with similarly bloody wars and the aftermath of it. And there was also, I think, a little bit of personal history in that. If you come from the background he did, of one being persecuted, being on the run, narrowly escaping first to London and then to New York, and seeing unimaginable terror, I think in a strange way you are always looking for some kind of attempt to reconcile these things, to try and bring a little bit of order to the chaos. Obviously at different times he got that wrong, but I think that was the underlying philosophy he lived by.
John, you touched on this. There was something deeply unique about how we, the media, treated him, and other countries as well, is in the 70s. Live from New York City this morning, good morning.
From the world of politics.
We're not going to be relying upon countries whose values we don't share.
To the world of business.
It's all about corporate power at the end.
Balance of Power. Live from Bloomberg's Washington headquarters.
We couldn't be more excited what's in store for you.
How long will it take? How many years?
Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join hosts Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
I think we're getting more of it.
That's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kayleigh Lyons.
The door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
That really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most.
This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure. With two more potentially to come.
I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority. From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kayleigh Lyons deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1.
Right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right? And making sure you have the right amount of people at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
When data comes at you fast, come up with answers even faster. SAS Via.
Is priced for soft landing.
The market is volatile right now because nobody really knows what to do or what to expect.
We still do favor the growth side of the equation. We still think that there is value in growth.
Right now, the long-term view is still cautious.
I think we'll be at new record highs for the S&P 500 early next year.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio. Alongside Lisa Abramowitz, I'm Jonathan Farrow. Closing out the month of November, wrapping things up with some choice quotes from some great guests. I'm thinking of the likes of Jack Caffrey at JP Morgan. What a year November's been. I'm thinking of Neil Dutt of Renmac, who's going to join us this hour. Neil saying it was soft landing Nirvana for the equity market, and wow, wasn't it? This equity market month to date on the S&P 500 up 8.5%, and we've got double-digit gains on the Nasdaq 100 for the month of November.
It has felt like a year because the narrative shift brings us right back to where we were not so long ago, and it feels like a year of narratives that were just packed into 1 month. How much do we see this sticking versus just the latest phase in table tennis or ping pong, as Jordan Rochester called it? This really is going to be the key question heading into December.
You want to talk about the bond market move? That's something like 60 basis points month to date, encouraged this week by some choice comments, some selective hearing, maybe, from Governor Waller, who was basically saying something's giving and maybe it's this US economy. There's one final chance to push back going into the quiet period. That is in the hands of Chairman Powell. Citi this morning saying Powell has the opportunity to push back against the cuts priced in when he speaks tomorrow on Friday. They call it a significant risk, but there's a big but here. If his colleagues are any guide, Powell's pushback will be limited and risk on conditions will continue.
And that seems to be kind of the feeling that it's unlikely that he's going to come out and put the kibosh on a market rally, because he hasn't seemed to show any willingness to do that at the previous meeting, even though he had an opportunity to do so. People said that maybe he was coming out overly cautious and dovish. That said, the data has surprised the downside when it comes to inflation. It's why core PCE, the deflator indicator that we get in about a half an hour time, is going to be so important. Do we have the ongoing disinflation that's going to give them comfort that actually we are getting back to price stability?
Should we talk about Ford? I think we should talk about Ford.
Okay.
Ford in the pre-market looks like this. Ford this morning reinstating guidance 10 billion to 10.5. That was lower than the previous guidance, which was suspended during the UAW negotiations. That was 11 to 12. But there are some massive differences out there between them and GM. GM notably coming out with a $10 billion buyback program yesterday. We did not get that from Ford this morning. Ford saying the costs from the UAW contract are going to come to about $900 to each car, shaving margins by 70 basis points. That is several $100s more than what GM was telling us yesterday. Make sense of that?
Well, they're saying it's for next year when a greater proportion of the contract goes into effect. I can't make sense of it. There is a component, as we were hearing from John Lawler, that there is a greater domestic U.S. focus of production of Ford. So maybe that's offset there, but it's unclear. And so it raises this question, first of all, how much is this a consistent cost? Second of all, how much clarity are we seeing in terms of what the costs are going to be and where they're going to be accepted? And third of all, just how much are we going to see this in margin compression? How much are we going to see this in higher prices? And what does this do to the competitiveness of U.S. auto manufacturers?
There was a key line from John Lawler, the CFO of Ford, in our conversation a little bit earlier. And I think it's a key line as we start to think about the jobs report next week. Here it is. We need to work on driving productivity and efficiencies and reducing the labour hours. Goes on to say the hours it takes to build a vehicle and reducing that cost. That, for many economists, when you get a labour market report, first thing to look for. Reduced hours, particularly when we're talking about holding on to labour because of the experience of the last 3 years. We couldn't hire quickly enough, so you're certainly not going to start firing. But if you want to make a move, if you want to pull back just a touch, productivity, of course, is one, but ultimately pulling back on hours worked, That's where you're going to see it first.
And that seems to be what's happening. If you take a look at the data, hours worked have been coming in slightly. But to your point, is this a template for what we're going to see elsewhere? That basically the way that you're going to offset extra costs is simply by increasing productivity, by reducing the amount people work and paying them de facto less, even if hourly they're being paid more.
TK said it yesterday, bombshell over at GM. I don't think just for the auto sector, I think a lot of people have got to look at that and think, oh, what's my move? What's my move into 2024? This is my move right now, this morning, and good morning to you. Here are the scores. Your equity market looks like this. Positive 1/3% on the S&P on the session, on the month up big time. We've talked about that all morning. On the session, yields are higher. On the month, aggressively lower. Your 10-year yield at the moment, 4.2859. We've got some Fed speak through the next 24 hours. Some data 25 minutes away. Elisa, jobless claims just around the corner.
Yeah, are you focused more on jobless claims or core PCE?
I'm going to go with claims,
really?
To be honest with you.
That's interesting.
Yeah, just to see them hanging in there at 200k. Personally, I say that just because I was so surprised last week. The question I'd been asking for the best part of a month off the back of some of Data's research, which I know you're going to ask him about a little bit later. Neil essentially was saying for the Fed, the labour market is no longer a reason to be hawkish. So I think the equity market started to pivot to, okay, this is what I need to think about now. At what point is that labour market going to be a reason to be bearish? Watch claims. Claims had been pushing higher, and now they're back down to 209. Is that just a blip into Thanksgiving? Is this kind of data distorted somewhat? I don't know. But just to have claims still down 200k, near 200k, unemployment south of 4%, deep into this hiking cycle is kind of surprising.
And it's a good point because when we talk about the disinflation, that's year-over-year comparisons, and Janet Henry of HSBC was just saying that come next year, those comparisons are going to get more difficult to beat. And so you might see a reacceleration of inflation. It really depends ultimately on labour market.
Absolutely. Joining us now on that, Steve Whiting, Citi Global Wealth Chief Investment Strategist and Chief Economist. Steve, good morning to you. It's always great to catch up, buddy. Let's just start with the Fed speak so far this week. Any reason to believe the message that we get from the New York Fed President John Williams, from the Chairman Jay Powell, is any different to what we've heard already?
Look, I don't think they can micromanage markets overshooting in both directions around their comments. It's actually good now to start getting the preconditions for the end of the tightening cycle, what it would take to ease these expectations, understanding that the Fed at some point is going to have to be forward-looking. It's not going to ease monetary policy when the economy has collapsed, right? If their monetary policy is restrictive, if inflation is falling to target, and I can definitely make the case for that, and employment decelerates, they're going to want to be careful about having restrictive monetary policy. Now, whether that takes 3 quarters or 2 quarters of time, that's the kind of thing that the economy will determine, right? But really getting this out and clear into the marketplace that their job is also not to force down the economy under every circumstances. That might be a little bit helpful, and I think the market has run off with that.
Given that, Stephen, are you leaning into what we've seen with respect to the bond rally? Do you think that the move that we've seen in November has legs, or was just another year packed into a month?
Look, I think it's a little too fast, but it's not too far. You consider where we think bond yields will be at the end of next year. We think 10-year yields will be 375. We think that the labor market is going to slow significantly. Fortunately enough, and this is the strange thing that's giving us a sense of bullish view of where we should be going without a contraction rebound cycle, is that a lot of industries have really contracted already. And if we were to take a look at their headcount, we're surprised it's not lower. Now, there have been other areas that have been asynchronous and employment is still growing. But we think that a lot of cyclical industries are going to find their bottom in the coming year and recover while the labor market is slowing, while measured inflation is coming down and bond yields are moderating. So that's a different financial environment from what we've been in the last 2 years. And again, you could run away with that and go too far very, very quickly. I don't think that we really overshot where yields will be or where the equity market will be if we look out a little further.
So then how have you readjusted, Steve? I mean, if essentially you don't think it's overshot, it has moved fast, does that just mean that basically you're not going to do anything for the next 2 months and wait for things to sort of catch up and then you'll take some action?
Well, okay, we've already made a bunch of changes, going back, particularly in October. Small and mid-cap profitable growth companies have had no return this year, and yet they're outgrowing large caps. And in fact, the growth companies don't have the highly indebted situation that small cap banks would. So we've added an overweight there. We think that a broadening equity market is the way that we will see the markets in 2024. It's not that we're going to get another 18, 19% gain in the S&P 500, but most stocks will be looking forward to a broader earnings recovery. So that's one way that we can play this. You know, another, again, is fixed income. Yields are down a little bit, but think about where cash will be in the next 3-4 years. The Fed's expectation for its long-term neutral policy, now whether it gets exactly to 2.5%, but that's where they are. So again, this rally in the bond market and thinking about some of the spread assets for high-quality bonds that are still north of 6%, you know, this is, again, the way you can still have higher for longer in your portfolio.
Steve, let's get into next year just a little bit more. Base case for a lot of people, slower growth, lower rates, which kind of screams growth and tech. Then at the same time, to your point, we are expecting this broadening out of a profits recovery. How do those two things compete with each other when we start to think about leadership?
Right. Well, look, Magnificent Seven have had a fantastic growth year. I mean, one semiconductor company has massive growth. If you take a look at the next 9, they don't. So when you think about valuation, I'm really not taking an active bet against large cap tech to really underweight or overweight. But the opportunity, again, in a world where a lot of the bond market in the world is still an incredibly low yield, 200 basis points below the US for other DM yields, is to take advantage of the catch-up, probably leaning a bit to growth, but not in the largest firms, right? Think about all of the cybersecurity companies that are not trillion-dollar companies is one example of that. Think about some of the healthcare companies that look like they've had their first recession. And that is, I think, an opportunity for broadening in the equity market.
Steve, got to get your views. Steve Wine in there of Citi Global Wealth. Appreciate it. Looking ahead, Lisa, to next year.
Yeah, I mean, this is going to be a key question going forward of how you navigate this. Again, I just think big tech is going to be everything. You're laughing at me. Why are you laughing at me?
I'm not laughing at you at all. Why would I laugh at you?
I don't know. I could just tell. No, but honestly, look, it is exhausting a bit that we're going into the same.
I just love catching Bramo sort of like transfixed by cat videos on our screen. How you do that and provide world-class bond analysis is beyond me. I don't know.
You know, I've got to say, my experience.
One part's to like calm down half the brain and then sort of like keep the other side engaged.
I mean, basically, yeah.
I love that. If you are just joining us, welcome. Your equity market positive here by 0.3%. Yields are higher by 3 basis points, 428.59. Lots to discuss. I just think Neil Dutter's been great over at Renaissance Macro. I know I say it all the time, but he has been. He's going to join us in about 18 minutes' time. He was constructive on this economy when many other people weren't. He's looking at the data right now. And if you just listen to the guidance from Governor Waller, and I think this is probably what you're going to get into with Neil a little bit later, Governor Waller's basically saying if inflation continues to trend lower. And Neil's sitting there looking at the data, and many Fed economists are as well, suggesting, well, let's sort of probe that if. How much of a if is it? How big is that if based on what's already in the pipeline? And for many people, it's not a big if.
Well, and this is the reason why a lot of people are talking about rate cuts even without some sort of recession. What I want to hear from Neil Dutta is how do you pair the idea of a nearly 9% annualized GDP in the United States on a nominal level for 2024, if you just 2023, if you extrapolate out the third quarter, how do you take a look at that and think that this is going to be successful, that disinflation will continue, that you'll be able to have enough weakness to cause the nirvana of soft landing to continue?
I think it's the fact that we've had 9% nominal GDP in the third quarter, that we've got unemployment south of 4%, that claims are at 209, and yet we've still experienced this disinflation. Don't think anyone wants to extrapolate out Q3 to anywhere based on the growth we just saw. But even if you keep it at 2, you get a slowdown. That's what surprised me, that we've had this disinflation even with everything we're talking about in the labour market and beyond.
Which is the reason why I wonder, how much is this gas prices? How much is this durable goods? How much is this just a shift versus services and goods that continues? And how much is this just year-over-year comparisons that are just difficult to beat once again? I mean, again, can we really shift the whole narrative once more?
If you want. And also, I've thrown a new one, another one. How much of this isn't the Federal Reserve?
That's a good question.
It's a big one too. AMH up next from Washington, from New York. This is Bloomberg.
want some conditions attached. It doesn't seem like the administration is supporting that just yet, but potentially that's what might be on some of this aid. If Congress is able to get this through, we could potentially see. But it is still a debate in Washington and is something that is looming large over this administration.
We'll get more on that throughout the days and I'm sure weeks ahead as this does evolve. I do want to just shift gears a little bit, Anne-Marie, and talk about the OPEC Plus meeting happening from COP28. The fact that it's virtual and that people are there talking about how they're going to reduce fossil fuel emissions while also negotiating how much oil they're going to pump. How much do you see this as really a result, the idea of making further cuts as a result of U.S. production, not necessarily just diminishing demand from consumers?
I really see this as a price issue. You know, the Saudis continue to talk about market stability. And when you see the fact that what has it been, 10, 13, almost 15% in the last 2 months that oil prices have dropped, that's a concern for these oil producing countries. Obviously, when you look at what the first quarter of next year looks like for the oil market, they are seeing a surplus. They want to flip that on its head. They want to see a deficit going into next year. So that's what this negotiation is about right now. I really think it comes down to market stability, or, you know, the diplomatic way of saying it comes down to price. Although no OPEC energy minister will ever tell you that's what it's about. It is what it's about. They need to work out, though, whether or not they can get the likes of Angola and some other African countries to agree to lower quotas. And if not, potentially we'll just see a rollover of what they have established last month.
It sounds like a defenseless CEO of a company, doesn't it, when they just start to say it's the short sellers, speculators, Wall Street.
Yeah, pretty
it's not the fundamentals of the company at all. AMH, what do they mean when they start talking about that it's the market environment, whatever they've said recently? What does that mean?
It means that they want higher prices. They want to put a floor under this. They don't want to see the dwindling of oil prices around the world. And they want to make sure that they're putting the speculators in the market. I mean, Prince Abdulaziz bin Salman has never been shy about calling out the speculators and telling them to dare him or tempt him. So I think that's what this is about. But it comes at a time when, you know, I don't think there's a lot of friction right now. Well, you'll see friction if OPEC Plus does decide to take this next step in a million barrels cut with the administration, because gasoline prices are lower right now. They could potentially give this one to the Saudis. They are helping them in the region right now with this war. Things are stable at the moment, at least in terms of this has not become a wider conflict. So potentially they do give them this out and they shrug this off where gasoline prices are, but potentially this could look a little bit different as we go into November of next year.
You've covered this for years, and I know this is slightly unfair, but based on your coverage, what is the number they want? Right now, Brent crude's at 84. If they're not happy with that, what are they happy with?
I mean, I think the Saudis deep down would love $100 a barrel of oil, but maybe something closer to 90. Certainly put a floor at 80, 85, but I think something closer to $90 a barrel. I mean, the IMF for years has said that's where their budget would need to be in line with. But yeah, around 90 to 100, I would say, would be their sweet spot.
AMH, thank you. The latest down in Washington, D.C. Anne-Marie Hordern there on OPEC Plus, a virtual get-together after cancelling the in-person get-together in Vienna. Manus Cranney very disappointed, by the way. Yeah, Manus thought he was going to get on a flight to Vienna and, you know, stay at the Ritz and all of that good stuff and then talk about oil. That's not happening. Coming up at the Open, this is happening on Bloomberg TV. We'll catch up with Priya Misra of JP Morgan, Krishna Mamani of Lafayette College, Stuart Kaiser of Citi. Lisa, I know you've enjoyed Stu's research over the last few months. A rally, at a massive month-to-date rally on the S&P 500 and on the Nasdaq. Stuart's point is this is not just about the bond market. This rally this year has been built on good data. And he says when that data starts to turn, you need to turn away as well and run away from this equity market. Until then, stay constructive. Jobless claims about 8 minutes away.
Good news is good news. Bad news is bad news.
Yeah, in Stuart's mind, yeah.
Yes, and the fact that he has to say that tells you where we are in this sort of upside-down world, and the fact that that's so controversial to say good news is good news and bad news is bad news gives you a sense of just where we're at in terms of this year. But I am curious to see how he paints that in terms of the tipping point and whether there's any leading indicator at a time where people are saying the jobs market's going to be lagging, that we're not going to really be able to trade the weakness until it's already too late when it shows up in the job market.
Drum roll, JP Morgan and a team. You know, 4,200 on the S&P 500. It's quite a price target. Against the grain, we got 5,100 at Deutsche Bank, 5,000 at Bank of America, 5K at RBC, and there's JP Morgan, bottom of the pile in the investment bank, looking for 4,200 with a downside bias. Their words, not mine. Absent rapid Fed easing, we expect a more challenging macro backdrop for stocks next year, softening consumer trends at a time when investor positioning and sentiment have mostly reversed. You said it earlier. I completely agree with you. Put the number to one side. When you go through the logic from the team over there, it's hard to argue against it.
To me, the big question is tech, because that's been the driver and that's been such a big proportion of overall returns. How much is this just a call on tech? Because the Russell 2000's done nothing. Banks have done nothing. A lot of the consumer discretionaries, yes, you've got the airlines, yes, you've got, although they're, hit or miss, and then you've got the cruise liners that are doing well, but a lot of the others not so much. So what are they talking about? How much does that composition shift? And increasingly, I mean, remember when we didn't really care about composition? It was just everything goes up or everything goes down. And suddenly now it matters.
Hang on a minute. This month everything has gone up, right?
Yeah.
Energy's had a tough time, but stock market index, bond market rallied.
I'm talking about back in the day.
No, I get that. I get that.
For like a decade,
We're reminiscing, nostalgia, all of that good stuff. All right. Equity futures, positive a third of 1%. Jobless claims, 5 minutes away. Neil Dutta, Renaissance Macro, is going to break down all of this with Lisa around the table here in
The quickest way from a billion points of data to a point of view. SaaSvaya.
The EU is one of the largest and wealthiest consumer markets in the world, and there are very few global companies that can afford not to trade in the EU. So as the price for accessing the European market, these companies need to obey European regulations. That's not surprising. But often these companies choose that they will extend the European standards across their global conduct and their global production because they want to avoid the cost of complying with multiple different regulatory regimes. So there are benefits to standardization, benefits to uniform production. So all the EU needs to do is to regulate the single market. It is then the market forces and the business incentives of global companies that transform that EU rule.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Messer and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Notion has been the centerpiece of my workflow. It's quite literally an extension of my brain. I can take notes, create folders, manage tasks, projects, set goals, and build products. It's so customizable, you can tailor it to fit your team or your own needs, not to mention it's beautifully designed. From being a student to a creator and now running a small business, the world is moving digital, and remote work and remote school are becoming the norm. We need solutions for digital collaboration and organization to stay productive, especially if we're in different time zones. And this is exactly why I use Notion. Notion is an all-in-one digital workspace for your entire team or just for yourself. And the best part, it's completely free. You can sign up using the link in the description or somewhere on screen here and start taking control of your personal productivity.